All right, Canada, let's talk about the storm forming over our economy. A weaker loonie is pushing prices higher. US tariffs could be the knockout punch to our already fragile inflation fight. And Stats Canada's HST holiday data, a complete illusion that's hiding the real problem. Meanwhile, we've got mobile usage showing a concerning trend in population growth, which tells us a lot about where this economy is really headed. If you care about your mortgage, your grocery bill, and how much everything costs in the year to come, buckle up, because today's rant is going to break your budget. First up, let's talk about our struggling Canadian dollar. The loonie is hovering near multi-year lows. Raw material prices are surging up to 11.2% year over year. Industrial product prices jumped 6%, meaning businesses are paying more for everything. A weak loonie isn't just bad for your vacation plan, it's a hidden tax on every single Canadian. When our dollar falls, imports get more expensive. Food, clothing, cars, tech, all of it. Groceries will cost even more in the coming months as the real effects of our weak currency start to show. Construction materials are more expensive, driving up home renovations and new build costs. A weak currency is just inflation wearing a different disguise. And this is before we factor in the incoming US tariffs. Now let's talk about the economic punch we're about to take from the US. Trump has floated a 25% tariff on Canadian goods. This isn't just political posturing, this could crush key sectors of our economy. Our exports to the US are worth over $500 billion per year. That's half our trade. Look at what's at risk. The auto sector. We export billions in cars and parts to the US. Tariffs here would kill jobs. Magna has 25.4% of their revenue in the US. Agriculture, dairy, beef, grains, all more expensive to sell, meaning lower profit margins for farmers. Nutrient, huge producer of fertilizer and potash out of Saskatchewan, has 60.8% of their revenue south of the border, and Saputo cheese has 45% of their market at risk in the US. Manufacturing, raw material prices are already up due to the weak loonie. Tariffs will make things worse. And here's the scary part. Canada doesn't have a backup plan. We are dangerously reliant on the US market. So what happens if Trump follows through? Exports fall, prices rise even higher, job losses will follow in key industries. We're already seeing early warning signs of job losses. EI claims are spiking in Ontario, and payroll data shows a weaker job market than what the government is admitting. Now let's talk about why inflation looks better than it really is. Headline inflation is at 1.9% year over year. Sounds good, right? Wrong. Take out the HST holiday, and it's a completely different story. The government temporarily cut HST on restaurants and alcohol, which artificially dragged down inflation numbers. But what's really happening? Shelter costs are still up 10% year over year. Rental prices are climbing 6% year over year. Raw material costs, thanks to the weak Canadian dollar, are up 11%. This inflation relief is purely a temporary gimmick. The second the tax holiday was over, the HST picked up again. You're going to see a hard rebound in inflation numbers. Now, here's a warning sign that most people are not paying attention to, and it's coming from Canada's big telecom companies. BCE saw a 56% drop in net new wireless customers in the fourth quarter. TELUS reported a 44.4% decline in new mobile users. Translation? Canada's population growth is slowing way faster than the government admits. Why does this matter? Newcomers fuel rental demand. They fuel economic growth and consumer spending. Lower population growth means less housing demand, fewer new businesses, and weaker retail sales. It also means job market weakness is coming. Fewer people spending equals fewer jobs needed. For years, the government has overestimated population growth. Now we're seeing the real slowdown in the numbers. This is going to hit Canada's economy hard in 2025. So what's the bottom line? Inflation is not under control. HST cuts are masking the truth. The weak loonie is pushing prices up on everything from food to construction. US tariffs could trigger job losses and economic slowdown. population growth is slowing, expect a weaker job market and slower economic activity. If you're planning your finances for 2025, here's what you need to do. Lock in mortgage rates before inflation rebounds. Avoid unnecessary debt. Credit card rates are rising. Prepare for job market uncertainty, especially in trade exposed industries. And most importantly, don't buy the government's fake inflation numbers. All right, folks, if this rant opened your eyes, do me a favor. Hit like. It helps if this video reaches more people. Subscribe because we break down economic trends that actually affect you. Drop a comment. How do you feel about inflation and the weak loonie? This is Vince Gaetano from OwlMortgage.ca. Thanks for listening. And remember, the wise old owl is here to help you navigate through the noise and provide insight to the financial chaos in the current environment. Stay informed, stay vigilant, and together, let's chart a path to financial stability. Cheers.